Welcome to the Meat and Potatoes podcast. Today we're here with Jay Tobey, who's the co-founder and CEO of FlowStreet. How are you, Jay?
Doing very well, Garrett. How are you?
I am good. Thank you. I like the name, and I think it's going to make sense when you tell us about FlowStreet, the founding story, and what do you guys do?
Yes, FlowStreet, which is a fun name we rebranded recently. It's all about getting capital moving, the flow. And what we do is we open the entry, kind of open the door to investing for the average everyday person. A lot of the deals go on behind closed doors in private equity and real estate. And most people just don't have access to those rooms or don't have the money to be able to put it in those kind of deals. So what we've done is we've lowered the minimum and we've opened the door to be able to have be able to invest in those kind of investments for just the everyday average person. So FlowStreet was really founded around helping the individual be able to participate in the private market. And it's all about, Wall Street, you're putting up a wall and you're limiting the access people have. FlowStreet's all about breaking that wall down, get your money moving, and kind of our overarching principle is cash flow back to the investor.
Yeah. And in this case, you could live on Main Street or Elm Street and be a school teacher or a product engineer and still have access.
Correct. Yeah, it was really built. My background was in what is called syndications. And what you do in syndicating is you identify a good investment opportunity, and then you usually gather investors to go into that opportunity. So that's what I was doing for the last 5 or 6 years. With apartments and with businesses. We would identify them, we'd raise, and what happened is we just saw there was such a demand for what we were putting together that we worked with the SEC for the last year and a half to be able to put the vehicle together to take accredited and unaccredited. And we can go over those terms. So really, it is being able to take everyone. We can take your neighbor down the street, or we could take Kim Kardashian's, a couple $1 million. So it really opens the availability. And again, we are really trying to focus on the cash back to the investor. We look at ourselves as more of a conservative vehicle at this point, to be able to go into something that's a lot safer and a lot, the risk reward model is kind of pulled back.
Got it. Which is, talk about a wall. You just mentioned the SEC. And I assume that was a lot of fun and a lot of hard work to be able to pull this off.
Yes, it was pretty tough. We're one of a handful of companies in the country that have gone through that process. And it's a really unique process because most investment firms, they have the model of least amount of investors, biggest check size, which makes sense. Their model totally makes sense for an investor relations standpoint and a headache relations.
Mm-hmm.
Jeff Bezos could write an entire check, probably the size of our funds and the size of our company, and then you only talk with that one individual or that one office. But with us and our model, we really tried to open it up for the individuals. And we did that because when I started going down the road, I was really interested in investments, not so much the public stocks. So the private market is like private businesses, private real estate. Public markets are bonds, stocks. People are pretty familiar with if you have Robinhood or if you've seen TD Ameritrade. And so luckily I was surrounded by some neighbors that had some really big wins, and I got to watch them and see that, oh man, they had private apartments. They were first employees at a couple of very successful companies that were private. The public did not get to participate in that. I came from a single mother household, so she saved, and she did the classic steps that the financial institutions tell you. And so I just got to look back and and see and observe in my youth. And then once I started, probably in college, getting way more interested, I started looking around and asking some neighbors what they invest in, and I just saw their thresholds were really high, and it was hard because I felt like, oh man, well, I want to participate, but for good reasons. Investments have natural risk. There's nothing. There's never such thing as like an unrisky investment. So they do put higher minimums to protect people's capital. But what we started doing is we started kind of being able to take some friends and family money and get them into some deals, and we started generating really good returns with that. And it was really fun to see our family and some friends participating in deals that they had never been able to participate in before.
Mm-hmm.
And it was really rewarding. And then the wave kind of just started building, and more people would reach out, more people would be interested in that. And so that's why we worked to scale it. We needed to scale. And so we went and looked for financial vehicles, and there's not many out there that allow this, because it is, hard to have so many investors in one investment vehicle. And you have to be just prepared for some firms would call that a massive headache.
Yeah.
But we like it. We want to be there for those individuals, because that's what we wake up in the morning trying to do, is help those people be able to generate some stable income. Because when I was looking out into the investment scene, I saw Robert Kiyosaki. People are like, the classic, like, let's go get into real estate. And a lot of people, I was young, so I had a lot of time. So I got to learn, I got to experience. But I met people at conferences that they had full-time jobs, families, and they were being told, get into real estate. Well, they're creating themselves a second or third job in some cases,
Mm-hmm.
to go identify what is a good deal, what is a good duplex. Then what are they going to do for management? What are they going to do for taxes? They've never done any of this. They don't have anyone in their surrounding family. And really, at the end of the day, most of them are actually just looking for some stable income stream.
Mm-hmm.
And so that was kind of our goal, is to, if we can overcome a car payment or overcome a cell phone bill, then we've been successful. Now, people put in larger checks that they have more, they can overcome their house.
Mm-hmm.
But let's just say our minimum, is as low as $250. So if you're yielding a 10% return, hopefully that does overcome your cell phone bill for the year. And then you can use that money to do something else. And that's what I really liked, which is kind of starting that financial freedom journey, because a lot of people's money comes directly from their W-2.
Mm-hmm.
And there's no good way to get an extra income stream.
Yeah. It's often talked about, but a lot trickier to do in the real world. And syndications are interesting, right? Like, you could syndicate a lemonade stand as an 8-year-old. Inevitably, like the horses that win the Kentucky Derby have a syndication of 4 or 5 owners, right?
Yeah.
Even the biggest private equity funds in the world oftentimes syndicate for the bigger deals
Together.
And it is a club
Yeah.
in all of these, right? And there's folks that are on the outside looking in, and it's just not feasible.
Right.
Um,
And so what we take a lot of those folks and kind of aggregate them together, so that those, they're large check size. We still write large checks, but then that business we're dealing with, or that apartment complex, the operator, we back solid operators. So then that operator's only dealing with one group, just us. And then we deal with all of our investors.
yeah. The proverbial like back office,
Yes,
which is key to victory, it sounds like, in this model.
for sure.
All right. So giving access and opportunity to a really broad group of folks on planet Earth, right? Or at least here in America for now.
We joke that, we're trying to look out for a niche amount of, a niche, but really that niche is most of, 90% of America.
Yeah. Which is cool, because win, lose, or draw, they're going to learn a lot more when they actually have skin in the game. about what you guys look at and do, which is you've mentioned real estate, private equity, and then like
Private credit.
private credit.
So the three asset classes that we really invest in right now, we have other funds being made right now that have different strategies, because that's one other thing we noticed is, yeah, it's great. Right now we have our fund that is a lot more diversified, but with that diversification kind of tamps down a lot of the risk, but it also tamps down a lot of the reward. It's made to be a stable kind of wealth preservation model. And so we go after apartment complexes that are just stable, they're income generating, they're built, we don't do any ground up. Then we go after storage units, same thing, usually historically pretty good in a up market and down market. Because that's one thing we really look at is how can we, you can never be fully recession proof, but how can we tamp that, what's doing well in a good market, what's doing well in a bad market. So apartment complexes are always good. And then we do private equity, and we call it growth stage capital. So those are companies that either have a good historic track record of generating very predictable revenue, or they're companies with, let's say, a few locations and they are quickly growing. And so we can use the cash flow that their existing locations have to cover our investors as we grow them. And that's where tech companies have been a hard thing for us to do, because they are big risk, big reward.
Yeah.
And so they're not usually something we go after. And then private credit is kind of a tree off of those other two, which is real estate lending. And usually they have great asset-backed loan to value ratios, which means that you have to lose, 30 or 40% of the value of the asset to even have your money at risk. And same with business loans. So that's what private credit is real estate lending and business lending.
Very cool. All right. So the idea is great. The work ethic to do this is great. This is obviously more than a one-person shop, because you've got to raise money for your company. You've got to get money from the niche of hundreds of millions. And then you have to find these great opportunities to invest in. So how have you guys built your team to kind of accomplish those three things, and how do you divide up the duties?
Good question. So what was nice is when we were going into this, we realized this was a lot more capital intensive than we would have expected up front. And it was, how do I say this? It was pretty unique. There's not a lot of people doing it. So there was a little bit of a blazing your own trail and making some mistakes and learning from them.
Yeah.
And so what is nice is I feel like we're really good capital raisers. So raising capital for our company wasn't really hard, because we raised capital for our company so that we could execute for the funds and then raise capital for the funds.
Mm-hmm.
And so we started off raising, and we really looked for strategic investors, people that could add a lot of value. They either knew the space or they had just a wealth of knowledge. And it was really nice. We were able to raise and have an advisory board which has probably sold over like 8 billion in companies. So they were really fantastic to be able to tell us where the cliffs are before we see them.
Mm-hmm.
And that was, for people starting off, it was kind of a one-man shop that I was doing syndications. It was great, but we needed to scale. And so we needed to put actual business processes in place. Plus there is a lot of reporting. We work as kind of almost a quasi public company in the eyes of the SEC. So you could only imagine, because the SEC does try to take care of the unaccredited. And this is just personal opinion, but in doing so, sometimes they only leave some of the more risky options on the table. Meaning, like, people have only access to crypto, and people are looking for different vehicles. They say, oh, great, I have my regular financial portfolio. What else is out there? And oftentimes it's really risky. So that's where we said, hey, we can be an alternative, and we don't want your entire portfolio. We are a safe haven for some of your capital. Let it, slice off 10 to 20% of your portfolio, put it over with us. We can generate the the returns, and then you could feel free, go be risky, put some money in a company that could 1,000 times your money, on the stock market or in other vehicles.
Yeah.
But that was a tangent. So we raised funds for our company, and we had awesome investors, some of which I can name drop. Some probably would not want us to name drop, but we have one of the funnest in Utah, which is Brandon Fugel. Fantastic. Our office is actually just like right next door to kind of his office building. And so it's fun to see him drive his sports cars around that area. And then some other really fun ones are the Jordan and Casey, which I think are going to get a little bit more involved in Silicon Slopes. They had a really good exit with Mountain Ops, if anyone's familiar with the supplement company.
Yeah.
And they've done a whole bunch of other things. That was just their most consumer facing one. And so they've been fantastic on the marketing and branding side. And that's what's so fun is we are a great consumer facing product. You don't always get that with the financial product.
Yeah.
Sometimes they're boring.
Yeah.
And yes, ours is a little bit boring, but FlowStreet, the brand, we're trying to make it fun.
Yeah.
And we have some reward programs that are coming out that we call it street cred. FlowStreet, get your street cred.
There you go.
And so those should be coming out in the next few months.
Very cool. It's good to have fun with it because life's too short not to have fun. You might make all the money in the world, but you might as well have some fun.
Yeah. And sometimes the financial world is a little bit boring. So we're just kind of coming in and saying, hey, there needs to be something that doesn't take itself as serious.
Yeah.
We don't wear suits to our boardroom.
Gotcha. Cool. All right. So you leave here and you drive home or back to the office, and you drive by 15 apartment complexes, and let's say it's the landscaping company for all of the Mormon temples, right? So that would check the box of like private equity. Well, that could be a nice little steady residual. And how do you guys like source your deals? What's the diligence like? And ultimately, like, who gets to decide? Is it the team? Is it one person?
We source our deals just because we have a good history in the space. And so we get a lot of deals sent to us at this point. When you first start out, you have to go find a lot of deals, but we have a lot of deals coming in. And what's fun is sometimes some of the funnest stuff we've gone into has just been brands we like, experiences that we like. And we say, how can we, bring this back to Utah, or how can we invest in this?
Mm-hmm.
And you'd be surprised at how many times you can find out who owns whatever and talk to them about investing and get the door open that way. And so that's some of the way. Due diligence wise, we really look at track record, health of the business. There's two metrics we really like, which are, how resilient are they in which kind of market? Because in a bull market, everything's going up. You're happy, everything's booming. What does it look like when the market turns? Is it wholly reliant on something, a user base or a government program that can change on a dime and it's only got one way, or can it pivot? How resilient is it is one thing we really look at.
Yeah. And is it by committee once you kind of find and zero in on these?
Yes, it's by committee. We have different committees with different experts on them for each different asset class, because that's one thing we really try to do is insulate ourselves, is to be able to make sure, hey, let's bring someone that's got way more experience than us and get their opinion on this deal. So that sometimes BlackRock had a good example of this. If you read some of their books, is their top level guys would just be the ones making decisions. And they did a deal where one of their interns or one of the lower, I guess in the corporate rung, lower people knew that it was a bad deal, but he didn't feel like he could bring up the reasons that it was a bad deal. And they went through the whole pain of few years of this deal really not working out. And when they did their due diligence on their back end, they found out, oh, we had the information, but we didn't have the right channel to get the information to the right ears. And so that's one way we took a lot of time working on the business. One of our mentors I really like, he talks about working in the business or working on the business. And this is good for some of the listeners building a company, is we took a lot of time and we're very strategic about with our advisors on how can we build this business? What processes and procedures can we put in place? Naturally, they will break as volume comes, things will come up, but they won't break horrifically. Then you can just tweak them. But sometimes people automatically just work in their business. They're trying to sell whatever there is, and they haven't thought through their entire process. So then they run headlong into an issue. And that's where those, sleepless nights end up. And that's where those working through the nights, those stories that you hear come up. And sometimes those are fun rites of passage as you build a business. But we've tried really hard to not do that and really work on the business for a long time.
Yeah, I love it. That is some really good insight there. So, little Jimmy Lipper's got $10,000, and you could put it on black. You could put it under your mattress. You could put it in Fidelity. There's a lot of things you could do with that. And thanks to FlowStreet, you could send it to you guys, right? And let's just, for funsies, this is an example. You guys take that money and you will allocate it in your first fund, which is called Aurora, right?
Yes.
Which is a mix of everything you already just described. And would that result in quarterly dividends, yearly dividends for little Jimmy Lipper?
Yeah. We're aiming for, our target is quarterly dividends. And so they have a 5% preferred. So no matter what, they're going to make 5% a year. And we try to really incentivize, like align incentives and say when they make returns, we make returns. Because oftentimes what we saw in the financial industry is they were taking a fee from just having the money in the account. And so we try to say, hey, we want to practice what we preach, which means aligning incentives to say, hey, if our investors are benefiting, we're benefiting as well.
Yeah.
And so we are targeting quarterly distributions.
Very cool. And then that math becomes fairly easy for little Jimmy Lipper, right? Like whatever you want to, IRR or ROI, ultimately like happens 4 times a year. It's pretty easy math.
Exactly. And then what's nice is we've really worked hard to also take retirement capital. So sometimes sometimes you don't even need to have liquid capital in your account, but you have this 401k money, and the average 401k lost 20 to 30% last year. And so too bad we weren't open last year to be able to carve off some of those and even, just get that steady return. Yeah.
And, we've talked, you got to live in 2 worlds, right? You're raising money for yourself. You're doing due diligence on those deals. What have you guys found to be the best way to educate the niche of hundreds of millions? And ultimately, like, what is proving the best way to get your leads turning into customers?
Yeah, we've just tried to be real to say, hey, we're like you. I literally built this with a model for my mom because she invested in a bunch of our deals. And I saw, wow, she had saved up a bunch of money, being a single mother, raising us, and she was able to deploy it and get great returns. And so I said, there's got to be other people out there like that. And they started coming. And so we've really been able to try to educate the average investor to say, hey, look, there are other options. Yes, go play in Robinhood, TD Ameritrade. But when we were in college, we put money in Robinhood and we'd always try to show our friends, oh man, I got this big green month. Things are going well. But we wouldn't usually show the entire portfolio to our friends because usually we were down because we were bad stock pickers, and we're betting against massive algorithms. And, it's in betting, you're betting against the house in that regard.
Yep.
And so I said, man, if there was a way that we could have we would have not been dumb, even though it was fun, and put some of that money just in a stable, cash flowing, higher return account for that entire time, we would be much farther ahead as a friend group. And so that's kind of a way we've been educating the masses. As we talk, we've only really been open for a month, so the word's just barely getting out. Things like this podcast help getting out, and then we're really honed in and focused kind of on the Intermountain West before we launch nationally. Luckily, the internal investors, they're used to working with large national companies, taking their companies really large. So we're well prepared for that, but we really want to make an impact in our backyard. We're from Utah. We've been investing a lot in Utah, even though a lot of our investments are outside. They're in Texas. We have some in the Pacific Northwest. We just want to give back to the Utah community.
Very cool. And where do you guys go from here as like you build out the team? What types of folks are you guys going to look to hire? What kind of methodologies do you guys use to have a good culture and kind of never forget the mission, which it sounds like kind of was a culmination of your experience and then ultimately your mother's experience.
Yeah. And sometimes we just try to have the culture of helping the individual, to remember those people that aren't able to participate. Most people come from that world and that realm. And so we want to be very good stewards of the capital, because sometimes this is a big check. They've never dipped their toe into the private sector. It's very new for them. And so they're used to putting money every month into a retirement account, or they're used to giving their capital to someone else to manage. And so sometimes it's a little scary, and we have to be very aware of that. And so we are really building out education, for the investors, is saying, hey, you don't see a lot of the investments we make on the back end and how we do it, but we're going to try to educate you on some of the basic terms, so that if you ever do want to go out and, try to buy something yourselves, that you at least have some of the financial know-how.
Yeah.
Or are at least used to and able, to know some of the terms and some of the strategies behind it.
Yeah. Which is a big deal, right? If you're wanting to get into sailing and you live in Utah, there's a good chance that you'll probably find somebody that has a sailboat and maybe go on like a 4 or 5 day cruise. You'll get like a pretty good base of that, but it is intimidating, right? A bunch of new acronyms, just like in finance and investing.
Yes.
A bunch of weird rules, written and unwritten. And, but if you apply a little bit of effort, you'd kind of be surprised how quickly you kind of get in that rhythm of like, all right, I know what you're talking about now.
Yeah. Honestly, when I was starting, I remember picking up a Bigger Pockets book, which is a very heavy real estate education platform. Great podcast, great place to start learning about real estate. And my neighbor gave it to me, and I was reading it, and I felt just so smart. I was like, oh man, this is so cool. It was gibberish. I did not understand what it was saying.
Yeah.
It's funny to look back because they were terms now that are very, very basic, but it was just having that experience. I like to use the analogy of playing a basketball game, a pickup basketball game. A lot of people try, if you have never seen a game of basketball played before, you don't know the rules, you don't know strategies. A lot of people in different walks of life are trying to play in the game without really ever seeing the game played first.
Yeah. And
so that's where we kind of see, dip your toes with us. We'll try to educate you on the game. And hey, we know we're not trying to be, the next Warren Buffett, the best investment firm in the country. We are just trying to be really good at stewarding capital, being able to take care of our investors and let them have the first experience probably in the private sector.
Love it. Thank you so much, Jay, for joining us. Really love the model. I can tell you're excited, and it's always cool when something new kind of appears where it gives people access. And I'm sure it's been quite the journey. So congrats to you and your team.
Thank you. Thank you. Our catchphrase is getting a cash flow state of mind.
There you go. I'd like to get into that state of mind at some point in the future.
When we all.
Thanks, Jay.